Well, I think we're going to need all the time we can get, so we're going to dive in. It will be recorded for those getting in late. But welcome, everyone, and welcome to our discussion on the evolution, dynamics, and trends in the retail real estate sector. We're in a fascinating period defined by rapid shifts in consumer behavior, macroeconomic pressures, and technological innovation. My name is Dan Broderick. I'm a 25-year vet in the commercial real estate sector, and I'll be your moderator for today. As a quick housekeeping item, there is a Q&A button in the bar below. Please click on that to put questions in as we go. We will have time for Q&A at the end, but we would love to be interactive and add your questions as topics come up. So please don't be shy. A few quick things to set the table before we introduce our panel. Coming out of the GFC, retail was left for dead. We had too much in every market, malls were failing, and demand and rental rates were all but flat for a decade. However, we can never bet against the US consumer. As we all know, consumer spending makes up 70% of our GDP. I want to pause on that for a second because to put that in perspective, of the other G8 countries, their consumer spending relative to GDP is in the low 40s to low 60%. We are a consume and throw it away economy. We have the largest waste per capita of any country in the world. And I don't say that to be doom and gloom, but this is good for retailers. So a couple headlines that I found recently that shed light on the confusing and confounding nature of the messages we receive in the market today. The first one is fast casual sales are down year over year. Sweetgreen CEO says the consumer is not in a great place. The young, the hip, they're pinching pennies. Alcohol consumption down to record lows. US corporate bankruptcy filings in 24 are the highest in 14 years, led by the consumer discretionary sector. Net absorption remains negative as closures take effect. However, on the positive side, the headlines are equity markets are at all-time highs. The 10-year treasury is flirting with 3% territory. Rates are due to come down, hopefully in a few hours. Air travel demand is up. Announced openings outpace closings in 25. Retail investments climb year over year. In the first half of 25, retail sales are up. Retail asset sales are up 23%, with a surge in the West of 107%. Has the tariff impact been fully realized? Is it all going to be passed through to consumer? By nature, consumer behavior is elusive. We have weather dynamics, seasonal issues. Some say you need a consistent holiday season to really see what's going on. So all that is to say, our goal for today is to go beyond the headlines and explore the deeper forces reshaping this industry. To do that, I'm privileged to announce our three panelists who are the brightest minds in the business. We made a deliberate choice to keep it to three to ensure a more dynamic and fluid conversation and give everyone enough time to voice their perspectives. So first, we have Caroline Wu, our data scientist. Caroline translates complex consumer foot traffic data into actionable business intelligence. Caroline carries 2 degrees from Stanford, a master's in sociology and a bachelor's in international relations, and she is now the director of research at Placer AI. Her professional background is distinguished by a deep focus on consumer insights and analytics, with a significant experience from leading firms across multiple industries. If you're in retail, you know of Placer AI. They're a leading database and aggregator in the industry, and they provide insights for how to take actions with assets and investments. And you'll learn more about what they have to say shortly. Next, we have Michael Strauss, Vice President of Development at Kimco Realty and a GSB graduate. Kimco is a preeminent retail REIT and operator. They're a part of their strategy that is unique is that their assets are 80 to 85% grocery anchored. They focus on necessity-based goods and services that generate consistent and frequent shopping trips. Michael is our operator developer with an on-the-ground understanding of how these broad trends are executed in practice, from redevelopment to tenant curation. And last but not least, my good friend, Jonathan Chang, president and founder of Tourmaline Capital. Jonathan is our capital strategist, here to provide financial context and explain where investment is flowing in this dynamic market. Jonathan is also a dual Stanford degree holder. His extensive professional background is rooted in acquisitions and capital markets. Tourmaline is a full-service real estate firm focused on operations, repositioning, and redevelopment of retail and mixed-use properties in the Western U.S., where they've acquired over 35 centers. So their expertise will offer a 360-degree view of the sector, connecting the what, which is consumer data, the how, development and operations, and the where, capital allocation. Thank you all for joining us. And Caroline, we're going to kick it off with you to drive us into some data to ground our conversation forward. But first, we want to hear an interesting story and a fun fact about your time at Stanford. Welcome to the show.
Yeah, well, one interesting fact about me at Stanford is that I was a tour guide. So, one of the funny stories is I was once leading a group, and they were looking around and they're like, "Do you have any famous people here?" And we turned around and there was Chelsea Clinton like riding her bike right across. So that was kind of a fun one. But love being an ambassador for Stanford, and love just always sharing stories with people and sharing knowledge.
Well, thank you. Will you share some insights and data from Placer with us to kick us off our conversation?
Absolutely. Let me go ahead and share my screen. All right, Dan, can you give me a thumbs up if you can see that?
Gotcha.
Okay, wonderful. Well, thank you so much all for coming to this webinar. Thank you, Dan, and the rest of the panelists for having me on. I'm very excited to share some insights with you today about what's going on in retail. Just a very, very quick overview of Placer for those of you who don't know what it is. We use mobile devices to track foot traffic. We have over 30 million devices. This gets extrapolated to the US population. And so as a result, we are able to take a look at people's foot traffic behavior. We can tell the full story of any location. These are just a small subsample of some of the things that we can track, everything from visitor journeys to where people were before or after a particular point of interest. We track events for marketing teams, so you can see ROI on marketing events. Our customers also love learning about customer demographics and sort of who lives in a trade area. And of course, commercial real estate, we have things like void analysis that help you identify tenants that might be good for your shopping center or mall. Just a quick overview of some of our clients. We have over 4,500 industry leaders. You can see some well-known names there in that CRE box to the top right. But we do cover a whole host of industries and categories. Always, as long as there is a physical presence and people are there, we are able to track it. So with that, I'm going to jump into some of our macro trends that we're seeing. I know everyone's very curious about sort of what's been going on in retail in 2025. So here I have kind of a January through late August overview of what's happening in retail. This is based on our Placer 100. So this is an index for retail we have. It has a lot of the big chains in the US. So as an example, we have Walmart, Kroger, Ulta, et cetera. But you can see here kind of looking at the variance of how foot traffic for this sort of top 100 retailers has been working this year. Of course, sometimes we're going to have seasonality, so we'll kind of show where there was perhaps a snowstorm, for instance, last year in 2024, hence the variance is much higher. We sometimes have calendar shifts like Easter and stuff. But I would say the overall story here is that retail is actually still pretty strong with the consumer confidence. We know there was a lot of sort of uncertainty about some of the tariffs. So you can see there that sort of mid-March, we had sort of a pre-tariff rally as people were stocking up in anticipation of various tariffs happening on different goods coming from different countries and things like that. But actually, for the most part, if you look at sort of May and later, the foot traffic has actually been, pretty steady and a little bit higher than last year. Slight dip at the end of June, but even July, the back to school has been pretty strong. We do know a lot of retailers were aware that these tariffs would be coming ahead of time. They were stocking up. They were, lots of activity in warehouses, at the ports, et cetera, in anticipation of some of this. But overall, yeah, compared to last year, it's been pretty steady and or positive, kind of the second half of the year. On the next slide, we're going to take a look at essentials. So these are the things that, as far as share of wallet goes, you kind of have to buy, right? We have got grocery stores, different types, value and conventional. We have the warehouse clubs like Costco, for instance. Dollar stores have been a really interesting story this past year as well. So you can see from this chart that some of the winners that we have here in terms of traffic, we have the pink line, which is value grocery. So that's definitely on the mind of a lot of consumers as they're looking for value. We know, the panel we were talking about how, oh my goodness, steak prices have gone up, egg prices have gone up, et cetera. And, the consumers very aware of all of this. So value grocery is doing quite well in terms of foot traffic over last year. So that would include places like Trader Joe's, Lidl, et cetera. We see here the warehouse clubs are also doing well. So Costco, for instance, we're seeing some interesting shifts in behavior. So for instance, normally the warehouse clubs might trend a little bit older households with larger families. We're in fact seeing some of the, younger millennials and even Gen Z, they're actually like splitting their Costco membership. So we're seeing some of the portions of, smaller households, boosting their subscriptions and memberships to warehouse clubs. We see also that dollar stores are doing quite well. It's interesting because some of them have had to raise their prices, so it's not really a dollar. It might be $1.25 or $2. But again, that consumer value orientation is still holding very strong in terms of consumer sentiment. And then here we see actually conventional grocery is, trending at or a little bit above. So again, some people are choosing to, cook at home, as opposed to going out to eat, for instance. And then some of the ones we're seeing a little bit less traffic to drugstores. Largely that's been because of consolidation of a lot of these drugstore chains. So hence foot traffic is down. Some places don't have a corner drugstore anymore on every single corner of your block. Gas stations has been down. So we've seen sort of road trips and gas station and convenience store trips kind of decline. Again, could be related to the economy. And then superstores are actually seeing some pressure too. And so that would include Walmart, Target, for instance. Those are seeing a little bit of a decline in foot traffic compared to last year.
Caroline, it's interesting to see this migration sort of to the low cost providers and infer what that means of where the consumer generally is. But what does the data show us about the higher end of the retail sector?
It continues, and I've been saying this for the last couple of years, but sort of that K-shaped bifurcation. The affluent consumer is still actually doing quite well. They're still shopping, but interestingly enough, they too are even kind of being more value conscious. So if you look at Walmart, for instance, 2022 versus 2024, there's actually a higher percentage now of 75,000 household income households going to Walmart. So while they're still able to afford, some of those higher end products, they're still very value oriented. And then as of late, we are also seeing luxury being pressured. So if you recall during COVID, with sort of people getting stipends and staying at home and kind of, maybe not having to spend as much on experiences, there was actually a huge jump in purchases of luxury goods, jewelry, things like that. And, luxury really had quite a ride for, I would say, the last couple of years. But this year, we're definitely seeing some pressure. So, those kind of aspirational luxury buyers are less able to afford what they, could have a couple years back. And then even the kind of higher end luxury, at the very top end, we're seeing, success for brands like a Hermes or a Chanel. I think at that price level, people are, pretty resilient. But it's sort of at the lower end, I would say, of luxury that we're seeing some pressure. So
And
that's actually a great segue, Dan, into some of these discretionary trends that we're seeing here. So yeah, lots of colors going on, but definitely we can see that, one of the trends that we're talking about is what we're calling the year of reinvention. So people are kind of sprucing up their homes. So if you recall during COVID, there was a lot of pull forward in demand, right? You're home all the time. People were buying couches, buying beds. People were kind of trying to renovate their home to kind of as much as they could. And now we're hitting that sort of 4 or 5 year cycle post COVID, and it's kind of time to refresh some of that. So we are seeing home furnishing strength, particularly some of those softer home goods. So, like the pillows and the throws and, home decor kind of things. And then apparel actually has continued to be quite strong this year. I think a lot of the retailers, like we mentioned, did a good job of kind of anticipating some of the tariffs. And so actually still have enough inventory for consumers. And, they were kind of out there shopping for back to school. Now, granted, again, this goes till the end of August, and we know those tariffs kind of hit pretty recently. So, we'll keep a close eye to see what's happening as sort of the inventory goes down. I mean, there might be some really interesting things happening with holiday season coming up. For instance, a lot of the toy manufacturers are going to need to have anticipated what they think the trends are. And due to some of these tariffs, they might not be able to be quite as nimble as they were in years past, depending on, where the hot toy might be coming from and, how much it might be tariffed at. So that we'll keep an eye on. But yeah, some of the winners, like we said, apparel, home furnishings doing quite well. One that, has been struggling generally the past couple of years is going to be electronics. A lot of that, people will like to buy online, or, there's been some consolidation as well of some of those electronic stores. So that's kind of what's going on with discretionary retail.
Caroline, we have a live question in
Okay.
the chat. How do we know how much of the decline in gas and convenience is driven by EV adoption?
Oh, that's a very good question. I can look that up for you. I mean, I would say a lot of times it is driven by the economy as well, just because, we saw that when gas prices went up, people started getting gas less. And then usually, I use like outlet centers as an indicator sometimes. So, when gas was cheaper, we saw a lot more people going out to outlets, which are, going to be 45 minutes or an hour away. And then when we saw sort of inflation going up along with creeping gas, those dropped. But yeah, we could take a look and kind of see how, EV might be affecting it. But I would say overall, it's a little more driven by economic concerns.
Have any of the charging players figured out how to capture retail sales in their charging stations? I saw Tesla had opened up that restaurant, sort of experiential charging station in LA. I haven't been there yet, but I hear it's pretty cool. Has anyone figured out how to weave those two together?
Oh, you mean in terms of how long they're staying to
Yeah,
gas?
and capturing retail spend on the charging station site.
That is interesting. I think you could take a look and see how many people are, you could geofence that actual area of the charging, and then in that particular case, do the cross shop. I know for some of the shopping centers that have, let's say, outdoor charging areas, you are able to, take a look at that parking area and then perhaps see if there's cross shop into the shopping center. I would say, generally speaking, in terms of the footprint, unless a shopping center has a very large, space, and most of the ones I go to, they'll have, a row or 2 rows or so, but usually it's kind of a smaller portion of the overall parking.
Thank you.
And then thank you, Dan. And then I know because my fellow panelists have a lot of grocery anchored centers, I thought it would be interesting to take a look at how grocery is doing in terms of share of visits. Here you can see we have groceries in the blue, so it's holding pretty steady compared to pre-COVID. So we're looking at Q2 2019 versus Q2 2025. The big shift we're seeing here is, as I mentioned before, this kind of growth in the discount and dollar stores. So about a 2% share increase for those. Wholesale clubs increasing about 1% there. And then some of the general retailers actually losing some of the share. So that's kind of an interesting thing for the grocery anchored centers to think about is sort of what is the role that groceries play as part of your mix. Sometimes you can have one or both together, and that will kind of affect the mix. And which is kind of one thing that we see on this page. So I know one thing we're going to talk about later, Dan, is sort of impact of, non-traditional tenants. I just have an example here on the left side of kind of what fitness centers can do in terms of creating almost a new occasion for people to go to malls. So here, adding some fitness centers to these particular malls added more early morning opportunity. And then I know we'll be talking a little bit later about cross shop. So here's an example where, visits to BJ's Wholesale Club took off after the Aldi came. And again, we're talking about, in this case, some value-oriented consumers. So even though one is a wholesale club, one is a grocery, you can see there's still cross shop in terms of sort of their aim to, get as much value as they can out of their groceries, whether it's perhaps buying toilet paper at the wholesale club versus buying, groceries and more daily foods at Aldi. And then lastly, I just wanted to say thank you to everyone. If you are interested in some of these insights, we do have the anchor that we write on our website. So it's placer.ai. You can see there at the very last one, it's called the anchor. So we have all sorts of trends, everything from return to office. We have here emerging trends for commercial real estate, back to school. So encourage you to check that out. We have lots of really interesting articles about all sorts of things with commercial real estate. And so with that, I'm going to turn it back to Dan and the rest of the panelists.
Thank you, Caroline. We're going to move the conversation over to Michael. Michael, given that Kimco has predominantly grocery anchored shopping centers, how do you think about that sort of needs-based demand, the cross-shopping experience, and how do you curate an ecosystem in a center to drive the highest performance? Oh, and don't forget your fun fact from Stanford.
Well, my fun fact is probably similar to Jonathan's in that loved my time at Stanford, but the GSB that we knew and loved has since been demolished. And there's nothing like getting lost in a school that matches the name, but is a little bit unfamiliar. So it's all good and fun. Loved my time at the GSB. Before I get to your question, I did want to at least mention briefly that I'm speaking only for myself and not officially on behalf of Kimco Realty. I say that just because we're a public REIT and I'm not supposed to make news with my public comments. So just wanted to mention that. Just a real quick, just about Kimco, more for context so that I can properly answer your question. And that we're the leading owner and operator of high quality open air, mostly grocery anchored centers in the U.S. Currently, the official total is we've got 566 shopping centers with about 101, 102 million square feet. So the answer to your question is that our whole portfolio is truly built on retailers and customer experiences that are based on essential purchases. It's necessity. I'm going to quote here. It's necessity-based goods and services that drive multiple shopping trips per week. What that does, what the grocery anchored portfolio does, is it makes us more recession resistant. We're by having the necessity and essential purchases, people come to us a lot. That gives us some protection against some of the online and delivery sorts of threats that other parts of retail may be a little bit more susceptible to. The grocery anchor makes us stickier when we add the more experiential components like those that Caroline was talking about. And it also creates an amenity-laden ground plane where we can add mixed-use components, which is what I spend much of my days focused on. So the grocery anchor it keeps people coming and it makes us less subject to the whims of of our daily lives. People come by, they have an affinity towards where they get their essential goods. And we don't see that changing. So in general, at least particularly in the grocery anchored space, and obviously retail is diverse, but I would note that despite some of the scary headlines that Dan, you mentioned at the beginning, the state of our product type is strong.
Well, there hasn't been much developed, which we're going to get into in a second. But
Can't wait.
real quick, we talk about needs-based essential goods and services for retail a lot, but that's easy to define in a grocery setting. Beyond that, it becomes a little gray, at least with the folks that I've talked to. How do you define it at Kimco? What are the true needs-based essential goods and services beyond a grocer and maybe, a pharmacy?
Well, I think you nailed it. The key there is that the beyond the grocery part of your question, especially when you have a grocery anchor, we can lease around that. It depends on the location, it depends on the community, it depends on the retailers that are interested. We have a lot of the discounters that Caroline was talking about. In our portfolio, we have lots of services and restaurants. It's amazing how many different uses and retailers, from mom and pop to the biggest chains that we have across the retail universe. Pretty much everything goes with the grocery store. So I don't mean to evade your question, other than then there's not a lot of uses that aren't complementary, that we're missing in our grocery anchor portfolio.
Well, I'm going to move the conversation over to Jonathan. He's just chomping at the bit to get the microphone. Jonathan, thanks for joining us. I want to move the conversation a little bit into the capital markets environment. Obviously, grocery anchored centers have been sort of the premier asset class in retail for a long time, despite the doom and gloom of the sector over the last decade and a half. But as more capital looks at the space and is interested in the space, as there's been a supply-demand imbalance, there seems to be more capital that has come into the other sort of off-center product types within retail. Can you talk a little bit about, are the old metrics of anchored retail centers still viable? Is it still the darling of the sector? And can you talk about the more nuanced parts of the business and what investors are thinking as it relates to, power centers, traditional strip retail, maybe even single tenant net lease, et cetera?
Yeah, so I mean, I think specialization matters, much more now than it did in the last, boom cycle for retail, which was, 20 years ago. So in 04 to 06, anything retail traded at pretty, pretty high prices and low cap rates. And today, not all retail is created equal. And so, on the core side of the spectrum, right, you've got the grocery anchored that Michael talked about. Single tenant triple net is still probably commands the lowest cap rates, and the highest demand from investors. What has emerged from all this, and you touched on it, Dan, was kind of the nuance of how relevant is anchor retail. And I think the anchor still matters a lot, right? I mean, if you have a Whole Foods or a Trader Joe's or a Ralph's that does well, that there's nothing that can replace that. But what has happened is there is a bit of a nuance to the anchor, and people are starting to look at unanchored properties and shadow anchored, and as a result, those type of properties that do well, that are well located, that perform well, right? We look at tenant sales as huge for us. Those have generated a lot of demand from investors, and in fact, those trade at pretty close to core pricing. And have become actually very institutional. You have several REITs that have popped up that pretty much focus on unanchored and shadow anchored strip. And then you have right in the middle is kind of power center, and I think power still carries with it an inherent risk, just with the size of the anchors, the sophistication of the anchors, the weight and leverage those anchors have. But because, physical retail has done well, right, and survived out of COVID, which I think speaks to kind of bricks and mortar retail, there still is pretty good demand for power centers. Now those cap rates are higher, and we kind of look at power centers at call it a 7 cap, in that range. And then on the other side of the spectrum is B and C malls, and those are well into the double-digit cap rates. And you're really, only find demand from very opportunistic investors.
Well, we've talked a little bit about the lack of new supply, and given construction costs, land costs, cost of construction money and debt, it's provided a dearth of new development opportunities. So this question I'm going to put towards Michael first, but in that environment, in this environment, how do you think about growth of your portfolio when you're on the development side of Kimco? How do you pencil and justify doing development in this environment?
Well, thanks, Dan. What's funny is that my focus and where I've spent my career is retail development, and retail development now is a bit of an anachronism. It doesn't really exist. I mean, sure, there's the occasional shopping center that's being built, but the U.S. in general is over retailed. So there's just between that and the construction costs and some of the challenges with building new retail, you're just not seeing a lot of new retail product. So what retail development means, certainly more than it used to be, and in general, is that it becomes our centers are land banks to some extent. We have the opportunity to add density, such as with multifamily, that we're doing. But you're also seeing, to actually get to the answer to your question, we're seeing the retailers be more creative, be more flexible, move to smaller formats, just as Jonathan was talking about, that investors are more interested in some of the shadow, and some of the less traditional retail product types, for the retailers to grow as they want to, and as Wall Street is pressuring the public ones to be doing. They're just having to be more flexible. So our growth is coming from, number one, rising rents, because when we're not adding supply, the demand is driving up rents. So rents do continue to rise. A lot of redevelopment, whether it's to add density or whether it's to assemble spaces to put in boxes, or when boxes come up to split them up for various other retailers. I guess to the real answer to your question is that retailers and retail owners are just being more flexible, and ultimately, we're all having to look at sites on on an individual basis, and get creative. But that growth is coming, and we see it in our portfolio performance, and we see it in our placer data, which we look at and use all the time. And so the growth is happening, regardless of of the lack of new supply that's coming online.
Well, you touched on this a little bit, but there are these new uses that we haven't traditionally seen in retail centers. The trampoline gyms, pickleball, outfitters, and courts and all that. Is that a flash in the pan? Is that a systemic change in retail uses, this retail-tainment, as some people call it, experiential retail? How do you think about that in your centers? Is that something that you're leaning into, or is it something that you're maybe sitting back and watching a little bit how it pans out to see how it works long term?
No, we think it's real. We see a lot of demand from those sorts of users. We look at it on an individual basis. What's the best fit for for whatever space that we either have available or could make available. Caroline talked about the cross shopping. Cross shopping is real. It probably varies as to if somebody's going out for a for pickleball in one of the pickleball tenants, or for a for jumpies in a trampoline place. Are they really going to go pick up a pizza on their way home? Are they going to pop in for some for some milk and eggs? I don't know. It depends on the individual customers, but we track it, and we do see a lot of a lot of staying power from these guys. Now, obviously, there will probably be some consolidation in a lot of these spaces. Some will make it, some won't. I always think about, what's the next frozen yogurt, what's the next cupcakes. There are certain spaces that we all remember where there are a lot of entrants, and then they get they get whittled down. But a lot of these new users are paying good rents. They're seeing a lot of demand, and they're finding their way into our portfolios as well as the portfolios of others, within our product type, and lots of other spaces as well. Lots of industrial locations for some of these users. They'll they're anchors, and they'll attract. They have gravity, and they pull customers in, which is the key.
Yeah. Well, I was just reading something a few weeks ago about how Krispy Kreme's rise to dominance and how they're stumbling a little bit. Just another consumer fad out there that is waning. But Jonathan, how do you think about these other esoteric uses or new uses from an underwriting perspective? Does it change the risk profile? Does it change the metrics that you or investors are looking at deals?
Yeah, I mean, retail is always changing and transforming, so I think this is just a normal evolution of retail. But I think it's the same as like the type of retail. Like some of it works great, and some of it's questionable, and some of it's just uncertain, right? I mean, I think on the strong side, right, on ones that we think are here to stay, right? We're on the West Coast, right? So there's a fair amount of well-respected, Hispanic grocers in Southern California, and one of them just opened this new concept in Orange County, where they've got, instead of being 40,000 square feet, it's 80,000 square feet, and on one side is the full grocer concept, and that's about 40,000 square feet, and the other side is like a high-end Hispanic market, like food court, food hall type concept. It's like Italy, but for Mexican food and culture. And it absolutely crushes it, right? And the whole concept there, right, is you're combining, the essential based daily needs with something that's more entertainment and fun, and the two have merged very well. And it's definitely like the tenant that everybody wants in their center. Down the street from my office is the Skydeck, which is this kind of huge, once again, food hall. Not all food halls work, but once again, this is very high end, done very well. On the bottom floor is a grocer, and then outside of the Skydeck is the ice cream shop and the cookie shop. And so what you have is you have the families and kids that go. And then at night there's like a bar in the middle, and that opens up to all the restaurants, and you can have a drink and order from all the different restaurants. And so you're getting both the family traffic, but you're also getting the nighttime date night traffic, and that is done extraordinarily well. Whereas 20 years ago nobody wanted to invest in like kind of a high-end restaurant food court, and this was based on a concept they found in Barcelona. And then, kind of, you touched on the Sky Zone and the jump houses. I think those are here to stay, right? Anybody with young kids has probably spent every weekend there for birthday parties, and it works. And if you look at the metrics of these operators, they actually cash flow. Like the cash flow is incredible, for each of these operations. The aggregate credit sometimes is questionable, but the actual operation cash flow is great. And I think these are accepted uses now, whereas 10 years ago that was questionable. And so now these trade at that 7, 8 to 8 cap numbers, right? So pretty reasonable numbers. And then you have the unknown ones, right? I mean pickleball is the craze, right? I think everyone plays it. So you would think it would work. But I don't think the institutional community has accepted it quite yet. And I think more importantly, lenders are wary of it. I think Michael touched on it a little bit of the cross shopping. I think part of it also is like there's a bit of a concern: is this here to stay? What are the barriers to entry? And then I think more importantly, it's the credit profile of these users, right? You don't have one big national group with a huge balance sheet behind it that's doing it. It tends to be more mom and pops, and so then you've got an uncertain use with uncertain credit.
Makes sense. I'm going to switch gears a little bit to the Q&A. Somebody asked about Amazon, the effects of impacted bricks and mortar retail real estate. It's not just Amazon; it's all e-commerce. Can Caroline, maybe I'll start with you. What are you seeing in the numbers? I know you don't track e-com data specifically, but from a foot traffic standpoint, it doesn't seem to be impeding that growth and that demand for people to get out of their houses and get to bricks and mortar. But what's Placer's house view on that impact? It's taken, the e-com craze started in late 90s or early 2000s, and then there was the tech wreck and the dot bomb. But it finally has impacted industrial real estate. We saw that happen really in the run-up coming into COVID, and then certainly during COVID, the explosive use of last mile and e-com by retailers far and wide. Can you talk to us a little bit about how we've seen that show up in the brick and mortar space?
Absolutely. I mean, it's interesting that, Placer sort of went to market in the midst of all this COVID happening and everything shutting down. And you would think that as a result, people wouldn't want, maybe data about foot traffic, but it was actually the opposite because we're trying to understand, what is that balance between e-commerce and physical retail. And, even during COVID, a lot of centers were able to pivot very quickly. They had, curbside pickup. They had, people shopping for you. So you're still using that physical retail. It might not be you doing it. It might be Uber. It might be DoorDash, Amazon, et cetera. But there's still a need definitely for physical retail. One of the things that we were all just talking about, sort of the importance of experiential. So what we've seen at a lot of shopping centers is sort of the rise of restaurants, the rise of entertainment. Retailtainment is a very interesting sort of category because it does sort of depend on the operator or the concept. One of the things we noted this summer was that, Dave & Buster's and Chuck E. Cheese came up with these summer passes. So actually doing sort of a subscription model similar to like a Netflix or a streaming service or something like that. And that actually really boosted kind of their visitation and obviously loyalty as a result. People were coming obviously more frequently if you're buying like a summer pass or something. So I think there's also lots of interesting sort of ways to think about physical retail and how you can sort of increase engagement. We see Gen Z, actually their lives are so digital, right? Anyone who has like teenagers or below, I mean, they grew up completely digitally native with an iPad when they're like 1 year old or something. And so as a result, a lot of them actually like going to malls. They like having that in-person sort of being able to walk around. We talked about the tween Sephora trend and how they love sort of that experiential, being able to go to the mall, try on different things. And then we've also seen the fact that even though a lot of digitally native brands have launched, many of them are seeing sort of the wonderful aspect of having brick and mortar where you can, particularly if it's a celebrity brand or influencer brand, you've seen all the lines that show up for, a cafe opening or a new, launch of apparel or something. And those are a way for the companies to kind of get to know the customer. You can sort of represent your brand the way you want as either a pop-up or, a more physical store. So I think what we're going to see is probably a little bit of shift in what's in physical retail. We'll probably see more experiential things. So sort of that large footprint, thing like a fitness center, entertainment, some of that experiential dining that we have. And kind of when we looked at that sort of chart that I had on discretionary, things like electronics, socks, like things that little more mundane you might buy online. But I think we're going to continue to see physical retail and centers as sort of a place for people to gather together and kind of experience some things together.
Yeah.
I also
Oh,
think the other point to make is COVID forced retailers to reinvent and invest in their business. And so what came out of that was they created kind of the omni-channel box, right? And so no longer was the physical store just to sell, physical product that you went in and tried on, but it basically completed their physical and e-commerce line, right? And so you now can go into stores and you can return the products you bought online. You can try on something that they don't have the right size or the right color. You can order online. And then most importantly, they've served as last mile fulfillment. And that is the advantage that Walmart has gotten over Amazon and e-commerce, right? I mean, I think Amazon has its own advantages, but one advantage Walmart has is its physical footprint, and it's embedded in regional centers and neighborhoods. And I think that's what Amazon's getting, right? And that's if you go to a Whole Foods store, right, you can see it, right? If you go to the Amazon Fresh store, you can see it. The fulfillment part is a big part of their store. So I think e-commerce is forced, and COVID forced retailers to invest in their business and make their businesses stronger.
Right.
yeah,
And I would just add that it's just part of the recipe. It's baked in. We're still seeing growth. To Jonathan's point that that fulfillment is a big part where you see it, with when you're shopping, you might be shoulder to shoulder with someone who's fulfilling an order. But ultimately, we still think that people want to get out of their homes and they want to go pick their own tomatoes. I mean, from the grocery store, not necessarily from the vine. But you don't want to leave it to somebody who's just trying to fill a basket. Now, it's nice to have that option, but it's just all part of the retail universe that we all live in. But in short, maybe this is one of the themes of this webinar. I think that the death of in-person retail shopping has clearly been greatly exaggerated.
absolutely. It's always amazing how the pendulum swings in all walks of life, and it certainly has in retail. Um, Moving on, I'm going to take another question from the audience. This one's from Chad Hagel, our friendly founder of Spire. He asks, can retail rents continue to rise as the lagging impacts of tariffs? There's still inflationary pressures. There's labor shortages with, some immigration pressures, et cetera. As it becomes more expensive to do business and as the consumer gets a little more price conscious. We talked about the fast casual sales dropping. We've talked about price sensitivity in dollar stores and discount grocers. So are you seeing this show up in your centers? Are you still able to push rents when everybody's just feeling the pinch, both on the operations side of the business and the consumer side? I'll start with you, Jonathan.
Yeah, I mean, fundamentals remain the strongest they've ever been in the 20 years I've been in retail. So that being said, as a conservative investor, we're always like worried that's going to change. Certainly you're hitting peak pricing on rents. But we talked about it earlier. I mean, construction costs, they just increased astronomically, right? I mean, I think back in 2022 and 2023, we hear about inflation being like 8-9%. Well, in construction, it was like 25%. So construction costs, replacement costs have like doubled in
Yeah,
the last 6-7 years. And so the reality is the relationship between construction costs and rents it's still out of whack, and you can't make new construction pencil. And so something needs to give on that. And I realize there's other factors, and Chad, you mentioned those other factors, but still, there's still the primary relationship of new development and where construction costs are and where rents are. And because of, construction costs, if you look at the history of construction costs over the past like 100 years, like the only time it has gone down was like literally the Great Depression. Otherwise, it's flat or it continues to go up. So something drastic would need to happen to have construction costs come down. And so at some point, for these to merge, right, rents have to keep, kind of tracking up. So look, I'm careful to say that because rents are really high and there's a lot of noise in the market, but I do keep going back to where construction costs are.
So given that comment about this being sort of a Goldilocks period for the sector, are you finding opportunities to invest and add value given that the fundamentals are so strong? I imagine, the other operators are experiencing the same trends and dynamics, but are you able to find a needle in the haystack out there to buy something that's mispriced and add value and generate value add type returns?
Yeah, I mean, so I do want to clarify. Like, I don't. It's not all rosy, right? Not everything's great. I mean, there are a lot of boxes, coming available through bankruptcy, right? There's a lot of struggling retailers that, because of the tariffs, because of the consumer, that's spending less, and because of higher interest rates, there's several retailers that went out, and they went out right away, right? I mean, Rite Aid, Bed Bath, Big Lots, At Home. I mean, this Joanne, this all happened like within 6 months. And so that does put a lot of vacancy out in the market, and it takes time to fill it up. And then certainly that's where that construction cost, comes out. And so it becomes very expensive to fill these boxes. So it's not all perfect. And retail, I think, still comes with a fair amount of risk. So I will say that. But in terms of like opportunities, I think retail started off, the past couple of years coming out of like the peak, right? It started with higher cap rates, right? And so we've there still is a nice spread between where you can buy a retail center and where interest rates are. And also say there's a fair amount of product out there. And I think we have the ability, now to kind of underwrite appropriately. So, rents, we feel pretty strongly about. I think interest rates have stabilized, and that helps you both on your financing assumptions, but more importantly on your exit cap rate assumptions. So I think there are opportunities. I think what we're finding is a decent time to sell and a decent time to buy. And so it's a great time to be a retail broker.
Dan, I'd also note, adding on to Jonathan's comment, that yeah, there are some vacancies from some of the bankruptcies, and you're always going to see some tenants go in or some go out, and then others go in. I would note though that because new supply is not being added, that even when there are spaces that come available, they are getting leased because there's not enough of those bankruptcies and those vacancies to satisfy the demand that's not being met by product being added. So to Chad's to Chad's question, and to Chad's point, can they keep going up? I mean, probably not, not infinitely, obviously, but we continue to be astounded, or not astounded, we continue to be pleased by the strength of the American consumer that's driving sales, that allows some of these retailers to pay what it takes to put them into these spaces. So for the moment, we're not seeing weakness. To Jonathan's point, yeah, there's always risks. But right now, the at least in our view, or in my view, the positives are outweighing the negatives.
So following this thread a little bit, with the low vacancy, you obviously have your pick of tenants to go after, right? But you have always, and this is a question from the audience, rate, downtime, tenant credit and quality, term length. If you had to pick of which one of those is most important, which one do you pick? Which one do you lean towards? Again, rate, downtime, tenant quality, or term? I'll go with Jonathan first.
You can't say all of them.
I
Rent,
think you have to.
rent and tenant quality. I mean, those are most important. Term, I worry less about.
Yeah. How about you, Michael?
Same. The term is something more that the retailers, that the tenants will worry about. We're flexible, but to Jonathan's initial off the cuff answer, it's always going to be all of them. You don't have to pick, and to the extent that we choose to optimize to various factors depends on the individual opportunity, the credit, the use of the individual a tenant what's going on around them, the what's going on in the shopping center in the greater market. It's hard, even though a lot of people think of a retail space as a commodity. It's not. Every corner is different, every space is different. Every customer base is different, which is another reason why we rely so much on our placer data and other sources of data to try to sort through all of the noise and to figure out what optimizes a given space in a given center.
So I want to give a quick time check. We got 5 more minutes. So I'm gonna ask one question for all of you to opine, and then I'd like to close out. So if we want to be sensitive to the top of the hour. So there was a question about what markets are we most excited about. There have been, some markets have just been obliterated in the media and with office vacancy, which then it impedes retail vacancy. We think of, the poster childs for that have been places like San Francisco, downtown LA, et cetera. But the question is more, what gives you all excitement for the future of markets to invest in that may have been hurt by that foot traffic and everything else, but are poised to bounce back? So, Caroline, I'll start with you since we haven't heard from you in a little bit.
Yeah, I mean, it's interesting that you mentioned San Francisco because I think for a lot of the last few years, that's the city that's been hearing the most doom and gloom. But we are definitely seeing some bounce back in San Francisco, I think particularly with some of the return to office. I think with the AI boom, that's going to be a whole new sort of Silicon Valley 2.0, 3.0, et cetera. New York is one that I find very exciting. I think it has actually, as of July, come back to even, I think, 1% above its, office level from before. So that's amazing. They're having a lot of industries like finance, media, law that have called people back. And we're also seeing a lot of Gen Zers kind of post-college age flocking to New York. It's just a very vibrant city. The office and the retail and the housing is kind of all there next to each other. So the three pillars of the stool, I think they kind of all support each other. And so that's one city we're pretty excited about. And then also we're just in general have seen a lot of that migration to sort of some of the Sun Belt and the southern cities, and they're continuing to grow. So, the Dallas, the Austin, et cetera, things like that. Some of the cities in Florida as well. So those I think have a lot of opportunity. To what Jonathan and Michael were saying, you have to keep an eye on migration, on the trade area, sort of how your, clientele is shifting. The Hispanic supermarket and food hall is a perfect example of a way to kind of capitalize also on, interest in different ethnic foods among not necessarily just that culture. We're seeing it too with some of the Asian supermarkets and food halls, et cetera. So I think just keeping a close eye on sort of the taste and how your market is evolving, make sure you capitalize on those.
Thank you. Jonathan?
Yeah, I mean, so we're in West Coast and Western US. So we remain bullish on the suburban, core markets in those, obviously. I think, Carolyn talked about this. I think there's some interesting opportunities happening with the resurgence of downtowns in certain markets, right? So I think San Francisco is showing signs. I think downtown Seattle, downtown Portland are showing signs both with the commercial back to office, but also the government's administrations are doing stuff about it to clean it up. I still worry about, I mean, I'm in San Diego, and I still worry very much about downtown San Diego, and then downtown LA I think is also pretty troubling.
Well, thank you. I'm going to move us along. But first, I want to make a quick shout out to our host of this panel, SPIRE, Stanford Professionals in Real Estate. It was at our 10-year reunion where I ran into Chad Hagel and had a conversation with him about the idea of SPIRE and about bringing real estate to the university that had really no exposure or influence of commercial real estate in the curriculum or otherwise. It started in 2009. It's to my knowledge, the biggest and most robust and well-led and operated alumni-affiliated organization of the university. It really serves to be that catalyst to educate, to inform both students and alumni about the built environments and all the things that are going on in the commercial real estate sector. And it never ceases to amaze me the alumni who are the who's who of the commercial real estate sector from a university that didn't have a master's in real estate, didn't have a single real estate course while I was there. I know that's changing, thank goodness. But anyhow, I want to thank SPIRE for hosting this. And then I want to close us out with a quick around the horn. So the lightning round is I'd like you to opine very quickly on what keeps you up at night, what gets you excited in the morning, and if you have any advice, knowing that some of our audience is new to the real estate sector and the retail sector, what piece of advice would you give a young professional or a new professional looking to get into the retail space? Michael, I'll start with you.
Let's see what keeps me up at night is probably still bears. They're scary and they've got teeth. What keeps me up
The
at
cow
night is,
bears or just bears?
no, well, not that scared about a cow bear, but anyway, I would say I would say just the regulation. Some California makes it really hard to do what we do. So sometimes well-meaning lawmakers getting a little carried away is a little bit scary. And then in terms of advice, I would say that we all love what we do, and we love to at least in my case, I love trying to make amazing places for people to to come to spend time in, to shop at, and increasingly to live at as well. So I'll leave that there.
Thank you. Caroline?
What keeps me up at night? I'm always trying to figure out what is the next big hit, either the next big brand, the next big concept. I love traveling internationally, so I love getting ideas from other countries and being like, can that be brought to the US? It's just so much more of a global society now. And for anyone entering real estate, I would say stay curious and get your feet on the ground. I mean, I learned so much on my just shopping center walks, or anytime I'm in a new city, I like to kind of check out the downtown, check out what's different. So I would say definitely just like roll up your sleeves, walk around, and stay curious.
Go out and be in the world.
Yes.
AI can't do it all for us. Jonathan?
Yeah, for what keeps me up at night, I mean, I've been in retail for 20 years and we finally have a strong fundamental market. So that's what worries me is we go back to the prior 17 years. And then piece of advice for people trying to get into real estate. I mean, I'd say don't worry about working for like a place that invests in large projects or cool projects. Find a place where you can learn, and more importantly, if you can find a place where there's somebody that's going to mentor you, that will pay off in dividends in the most important parts of your career.
Great advice. Well, thank you. That was an incredibly insightful conversation. We've covered a lot, from data-driven reality of the consumer behavior, which is ever elusive, to the financial imperatives that are driving the development or the lack thereof, and some technological shifts and changes within the retail industry. So I want to make a huge thank you to Caroline, Michael, Jonathan. Really appreciate the time and the energy you put into this. I want to thank SPIRE for hosting it and reaching out to all of us. And thank you to the audience for joining us today. I hope you walk away having learned something and are inspired by what's going on in the retail sector. So thank you all. Have a great day.
And thank you, Dan.
You.
Thank you.